Hi, let's talk about the math that destroys your peace of mind. How Buffett really made his money. Forget the gurus, forget the headlines. Let's get brutal about what happens when you panic. Picture this. Your screen shows a graph. It's plummeting. Your portfolio just dropped 50%. Half your money gone. You see that number and a cold knot tightens in your gut. That's loss aversion kicking in. Big time. It aches. Now, here's the sucker punch the pros don't want you to think about. To get back to even, just break even from that 50% drop, you don't need another 50% gain. No, you need a 100% gain. That's double your money. It's on the screen right now for those of you watching, a stark reminder. A 50% loss demands a 100% recovery. This isn't some abstract concept. Imagine it's 2022. Tech stocks are tanking, Bitcoin's bleeding out. Your portfolio is down 40%. The news anchors are screaming about recession, inflation, the end of times. You panic sell to stop the bleeding. You tell yourself you'll buy back in when things stabilize. You just turned a temporary dip into a permanent scar on your wealth. This is the bleeding neck problem. You severed the head to cure a headache. Every time you react to a headline, every time you bail out, you aren't protecting your capital. You are actively digging a hole you can't easily climb out of. You don't just lose money, you reset your entire compounding clock. That exponential growth that turns small sums into fortunes, you just hit the emergency stop button and then tried to restart a half marathon from the beginning. It's exhausting. It's futile. The bottom line is simple. You cannot time the market. You cannot outsmart the herd when the herd is stampeding off a cliff. The truth hurts, but ignoring it destroys your future. Now, most people picture Warren Buffett as this folksy billionaire grandpa, sipping cherry Coke, dispensing folksy wisdom. That's the PR. Let's strip that back. Let's talk about Warren Buffett, the ruthlessly disciplined 26-year-old fund manager. This guy wasn't some eternal optimist. He was a shark. He hated losing money more than he loved making it. That's the critical distinction. He wasn't playing to win big, he was playing not to lose at all. He didn't beat the market by guessing. He didn't have a crystal ball. He beat it by writing a constitution. He codified a set of unbreakable rules that governed his every investment decision, especially when fear took over. And today, right now, we steal his rules. We adapt them for your busy life. If this hard truth about loss aversion hits home for you, drop a like right now. Most people think Buffett just buys good stocks. That is a lie. He actually uses a 3-bucket strategy that almost guarantees he wins even if the market crashes. You are not an investor. You pull up to that red light. Phone buzzes? You have to check it, right? Green number? You feel smart. Maybe a little rush. Red number? A dull thud of failure, a whisper of panic. This dopamine loop isn't just distracting, it shatters your returns. This isn't just about stocks, it's about every time you chase that immediate gratification, the quick win, the easy money. That's precisely why the average retail investor underperforms the S&P 500 by massive margins. Here on Audiobook Bites, we distill the best books into actionable insights. But nothing beats the original. Grab the book if you want the full deep dive into these mind-bending concepts. Now, let's confront a harsh reality. You think you're an investor. You're not. Not yet. You're a ticker watcher, a market gambler, and that needs to change today. Buffett understood this core human weakness. He knew people couldn't resist the urge to react, to panic, to chase. So he instituted what he called his ground rules for his partners. This wasn't some gentle suggestion, it was a literal binding contract. He demanded adherence. Here's the kicker. The ground rules were brutally simple. 1. No daily quotes. You weren't to look at stock prices. 2. No disclosing holdings. You couldn't talk about what you owned. And 3, absolutely no reacting to news, no buying on a hot tip, no selling on a scary headline. Honestly, this sounds impossible, right? In an age where Robinhood screams notifications at you, where financial news is a 24/7 circus, Buffett essentially said, go dark, trust the process, be blind. This wasn't just about discipline, it was about shifting your entire identity. Here's the gut punch. You treat the stock market like a slot machine in Vegas. You pull the lever, you wait for the payout, you curse when it doesn't hit. Buffett, he treats it like a grocery store he owns. He doesn't obsess over the daily price of milk. He focuses on the overall health of the business, the margins, the long-term value. He cultivates his enterprise, not just cashes in chips. This isn't just an analogy, it's a complete mental overhaul. A grocery store owner doesn't sell off the dairy section because milk prices dipped for a day. They ask, is this still a good business? Is the management sound? Are people still buying milk? They think like an owner. So here's what you can do right now to forge this new identity. This is the actionable step. Stop checking your portfolio daily or even weekly. Seriously. That constant peeking, it's emotional self-harm. Every glance fuels either false euphoria or genuine anxiety, neither of which leads to rational decisions. You wouldn't weigh yourself 10 times a day to achieve your fitness goals, would you? It just creates an unhealthy obsession. I get it. This is hard. Your phone begs you to check, flashing those little green and red numbers. Your buddy from work just bragged about a quick gain. The fear of missing out, the fear of losing money, those are powerful drivers. But those notifications, those headlines, they're designed to make you react, not think. They want you to trade, to generate fees, to stay glued to the screen. If that little dopamine hit from checking your phone at the red light hits home for you, drop a like. It means you're ready to break the cycle. To break this addiction, you need the Predators framework, the specific way Buffett categorized every single dollar he spent. The Predators portfolio. You're probably feeling it, that constant financial tightrope walk. One eye on your brokerage app, the other on your grocery bill that just shattered last week's record. The market's a fickle beast, and frankly, relying solely on its good mood for your financial future, that's a fool's errand. You deserve better than just hoping for the best. We're cracking open the Predators portfolio today, and this isn't about blind faith. This is about strategic dominance. We're dissecting a framework that redefines risk management, generals versus workouts. Forget everything you think you know about diversification. This system fortifies your portfolio against the inevitable storms, pulling lessons from investors who didn't just survive, they thrived in markets that would give most modern traders an existential crisis. Let's drill down. First, the generals. These aren't just any stocks. These are your undervalued juggernauts, the companies whose intrinsic worth screams value, but the broader market, in its infinite wisdom, or often its infinite short-sightedness, just hasn't fully appreciated yet. They're like that hidden gem of a restaurant in a strip mall. Incredible food, but the masses flock to the mediocre chain next door. When the market surges, when the tide lifts all boats, your generals explode with it. They're your powerful offensive line, designed to dominate the field when the conditions are favorable. They create wealth. They amplify your gains. Then we have the workouts. Now, this is where the real grit comes in. Forget market sentiment. These are special situations. Think corporate mergers, company liquidations, spin-offs, even bankruptcy reorganizations where assets are being parceled out. The financial outcome here isn't tied to the S&P 500's latest mood swing. It's tied to contractual obligations, legal maneuvers, and the relentless march of financial engineering. These situations carve out value regardless of the broader economic climate. They aren't hoping for a bull market, they're executing on a specific event. Let's paint a picture you'll recognize. Your generals are your 9-to-5 job. It's your primary income stream, the one that fuels your lifestyle. When the economy is roaring, your company is thriving, you get that fat bonus, maybe even a promotion. It's glorious. But here's the rub. Your 9-to-5 relies entirely on a healthy economy, on stable industry, on not getting caught in the crossfire of office politics or corporate restructuring. If that foundation cracks, your income evaporates. Your workouts? That's your shrewdly built, highly profitable side hustle. Maybe you're a master at negotiating estate sales for vintage tech, or you're providing crucial, high-demand consulting services that no one else can touch. This side hustle generates cash flow irrespective of your main job's fate. Your boss could fire you tomorrow, the economy could tank, but that side hustle continues to deliver. You need both, right? Your solid 9-to-5 propels you forward, but that side hustle insulates you when everything else goes sideways. It's the difference between merely surviving and genuinely thriving through a downturn. Here's the undeniable truth, the core insight from those market titans of old. Generals make you rich when the market booms. Workouts keep you alive when the market dies. This isn't just a catchy phrase, it's your financial battle plan. Here's the grim reality of a bear market. Everything collapses. Your generals, those market-dependent growth engines, are shedding value, sometimes violently. Your net worth plummets. But those workouts, they're still doing their thing. A pre-announced corporate merger still closes. A company liquidation still distributes its assets. The payout isn't a speculative hope. It's a contractual obligation, a predetermined event that spits out cash. This isn't about hoping for a stock price recovery. It's about guaranteed cash infusion when everything else is seizing up. Honestly, the author's romanticized view of classic workouts does require a dose of modern skepticism. Back in the day, these were easier to exploit, less institutionalized. Today, pure merger arbitrage is often dominated by ultra-sophisticated hedge funds. Most of you won't have the time, the capital, or the sheer legal firepower to parse every single corporate filing for a fractional game. So are workouts dead for the average commuter? Absolutely not. The principle is timeless. The application simply evolves. So what does a workout actually look like for you in our present climate of inflation, rate hikes, and perpetual geopolitical jitters? It's not about replicating 1950s merger plays. It's about embodying the spirit of the workout, finding assets or strategies that are uncorrelated to the whims of the broader stock market. They provide independent cash flow. Right now, that might mean strategically deploying capital into high-yield cash equivalents. We're talking about those government-backed T-bills or even high-interest savings accounts that are finally punishing inflation with actual returns, not just treading water. Or perhaps it's certain alternative assets, properly vetted of course, that genuinely move on their own cycle. Think real estate crowdfunding for specific income properties, or even certain private debt funds if you have the access and risk appetite. These aren't just safe havens where your money just sits there, eroding. No, these are active generators. They inject reliable, independent cash flow into your portfolio, exactly when your generals are taking a beating. They act as your economic shock absorbers, preventing total financial derailment. This isn't just theory, it's about actionable defense against market volatility. If this hits home for you, drop a like. The bottom line, folks, is this: you must cultivate both types of assets. Generals provide the explosive wealth creation potential when conditions align. Workouts offer the critical survival insurance, the independent cash flow when the market implodes. Ignoring either strategy leaves your portfolio vulnerable, either to agonizingly slow growth, or worse, to a total financial wipeout. You need strategies that flourish in the sunshine and strategies that deliver when the storm hits. But how do you know if a general is actually valuable? Most of you are looking at the wrong number, specifically dividends. The hidden money glitch. You've scrolled past a million headlines, each one shrieking about market crashes or the next big thing. And let's be honest, you feel that gut punch when your portfolio dips or that little thrill when it ticks up. But here's a radical idea this book champions. Most of that daily noise, it's just background static. Here's the kicker. The author introduces us to a fantastic mental model. Imagine a manic-depressive cartoon character named Mr. Market. This guy shows up at your door every single hour, literally banging on it, offering to buy your house. Sometimes he's ecstatic, practically throwing cash at you, begging to pay double what it's worth. An hour later, he's in a fetal position, convinced the sky is falling, offering a tenth of its value. Now, would you actually sell your house based on Mr. Market's hourly mood swings? Of course not. You know what your house is truly worth, regardless of his temporary delirium. Yet how many of us treat our stocks precisely this way? We panic sell when Mr. Market is having a bad day, or FOMO buy when he's euphoric. This perspective shatters that instinct. You own a piece of a business, not a ticker symbol to obsess over. Your wealth isn't determined by Mr. Market's latest quote. Now, let's untangle something even more crucial, a concept called look-through earnings. This often gets overlooked, and honestly, the financial industry loves keeping it murky. But here's the unvarnished truth. If a company you own earns $5 per share, but decides to pay out a big fat zero in dividends, you didn't just lose out. Far from it. That $5, that's still your money. It's not vanishing into thin air. The company, ideally, keeps it to reinvest back into the business. That's your capital working, growing, often tax-deferred, right inside the company. Think about it. This strategy propels your wealth forward without triggering immediate taxes. It's akin to your side hustle income staying in your business to buy better equipment, rather than taking it all out, paying taxes, and then trying to reinvest what's left. The power here is undeniable. This brings us to a hard truth that might sting a little. Stop obsessing over dividend yield. Seriously, just stop. You buy a stock because it pays a 6% dividend? Great. But the stock price drops 10% because the company is slowly dying. You just lost 4% net. That's the insidious dividend trap that snares countless desperate retirees every year. It's not just retirees, it's anyone chasing a quick buck, anyone ignoring the underlying business. Instead, you need to obsess over how well management reinvests your money. Are they generating high returns on those retained earnings? Are they growing the business intelligently? That's what truly amplifies your long-term returns. And here's where we get controversial, especially for those chasing the next big tech fad. The author, much like Buffett, champions boring companies. Yes, boring. If a company is exciting, if everyone is talking about it, if it's constantly in the news, chances are it's already overpriced. Its future growth is baked into its current valuation, leaving you little room for upside. The real money, the deep value, is often found in the unsexy, predictable businesses. The ones grinding out consistent profits year after year, reinvesting shrewdly without the media fanfare. That's where your money works the hardest. If this hits home for you, if you're tired of the financial roller coaster, drop a like. Now, before you go replicate Buffett's 1960s trades, I need to warn you, Chapter 3 of this book will bankrupt you in 2024. The cigar butt trap? You're slogging through the traffic, probably wondering if that investment book you just started actually holds the keys to early retirement, or if it's just another relic from a bygone era. Here's a spoiler. Some of it absolutely is a relic. We're plunging straight into what I call the cigar butt trap. This isn't just about spotting bad investments. It's about shrewdly filtering what strategies are utterly obsolete, what to ignore in that audiobook. Now, what exactly is a cigar butt? Picture this. An old man, right? He's rummaging through an ashtray, discovers a half-smoked cigar, lights it, takes one last acrid puff, then flicks it away. That defines the investing philosophy. It's buying companies on their absolute last legs, businesses teetering on the precipice of bankruptcy. You snap them up for pennies, desperately hoping for one final, fleeting surge of profit before the whole enterprise collapses. One last glorious puff before the entire ashtray hits the dumpster. Honestly, the author's romanticized vision of this approach, it's charming, yes. It worked back then. In the 1950s, information dribbled out. It was slow, glacial. You, a sharp-eyed individual investor, could unearth hidden gems. You could dig through dusty reports, could discover undervalued assets, could exploit arbitrage opportunities before anyone else caught wind. Think of it, you were basically a financial detective, operating in a world where everyone else was blindfolded. Now, that entire landscape has irrevocably shattered. You're not Sherlock Holmes anymore. You're a guy with a magnifying glass staring down a satellite image, hoping to spot a specific blade of grass. Trying to chase deep value investing today, it's profoundly futile. It's like bringing a butter knife to a drone fight. You will get absolutely decimated by institutional algorithms. They're called high-frequency trading. These machines don't just find those dying companies in nanoseconds. They annihilate every micro-fluctuation, every single market inefficiency before you've even finished brewing your morning coffee. Your human brain, no matter its brilliance, simply cannot compete in that arena. It's not a fair fight. It's not even a fight. It's an unavoidable, total annihilation. So, here's the game changer. Stop trying to find fair companies at wonderful prices. That's the old game. That's the trap that will snare you. Today, your strategy must pivot. You need to identify wonderful companies, businesses with formidable competitive advantages, with rock-solid management, with an indisputable future, and then acquire them at fair prices, not at fire sale, cigar butt prices that scream impending doom. Think long-term, envision sustainable growth, contemplate owning a piece of a proven powerhouse, not scavenging for scraps from a financial shipwreck. This shift isn't just an investment philosophy, it's a fundamental mindset overhaul. It's about forging enduring wealth, not desperately chasing lottery tickets disguised as value plays. It's the difference between diligently planting a sturdy oak tree and frantically trying to revive a dead houseplant with mouth-to-mouth resuscitation. Now, for your Monday plan, this is where you seize control. I want you to launch a new document. Title it My Investment Ground Rules. This isn't just advice. This is your personal financial constitution, your unbreakable code, and we're etching 2 non-negotiable amendments right into it. Rule number 1, absolutely no selling on red days. Seriously. That sickening gut punch of seeing your portfolio dip, that's raw emotion dictating your actions, not sound logic. Panic selling guarantees you lock in losses. It's financial self-sabotage, pure and simple. You are meticulously building wealth, not carelessly playing hot potato with your future. Rule number 2, no buying without meticulously reading the 10K. Every single one. Don't skim the flashy headlines. Don't blindly trust Twitter gurus or forum chatter. Devour the actual financial report. Comprehend the business model. Grasp the inherent risks. This is your money. Treat it with the utmost seriousness. This simple discipline, this rigorous habit, will shield you from so much market noise and so many costly impulsive mistakes. These rules aren't just for investing. They extend into every facet of your professional life. Think about your side hustle, your career path. Do you abandon ship the second a project hits a snag? Do you commit to new obligations without diligently reading the fine print? Probably not. Apply that same pragmatic, unwavering scrutiny to your money. If any of this resonates with that busy, skeptical, smart brain of yours, if this hits home for you, smash that like button right now. It helps us powerfully amplify this message, because let's be brutally real, blindly adhering to antiquated advice is the swiftest way to transform your hard-earned dollars into digital dust. The bottom line here is crystal clear. What truly works now, what's merely history, and what's a complete, soul-crushing waste of your precious mental energy. So, is this book worth your time, or is it just a history lesson? The Wealth Verdict. You've been grinding, you've stacked your pennies. Now you're wondering if this book, this theory, truly unlocks something for your future? You deserve a clear, unfiltered answer. We've sifted through the hype, dissected the dogma. Time for the final verdict. No fluff, just the raw, unvarnished truth you can actually use on Monday morning. Here's the deal. Devour this book for its psychology. Seriously, it demolishes common misconceptions about wealth, about what truly drives our financial decisions, often against our own best interests. But when it comes to the actual math, the specific investment vehicles, the precise calculations, honestly, skim it. Some of it feels quaint, a relic from a simpler, slower time. The underlying mechanics, the precise instructions on how to structure a specific bond ladder, they're often dated, designed for a different economic landscape, a different interest rate environment. They simply don't translate directly to your 401k strategy today. The mindset, though, that's pure gold. That transcends time. That's the enduring wisdom you absolutely extract here. Think about it. The pressure to keep up with the Joneses isn't new. It's practically hardwired into our collective DNA. It just wears different clothes now. Back then, it was your neighbor's shiny new sedan in the driveway. Today, it's the highlight reels on social media, the curated perfection, the passive income gurus flashing leased Lamborghinis, the influencer peddling their latest can't-miss crypto coin. This book exposes that core human vulnerability, that insatiable desire for more, for instant gratification. It arms you against the relentless noise, the endless chase. It teaches you to cultivate resilience, to understand that genuine, durable wealth isn't about accumulating more than everyone else, it's about achieving enough for your goals. It's about shielding your financial future from the constant chatter, the whispers of office politics about who's getting promoted and what they're buying, the exhausting side hustle mania promising instant millions while demanding all your spare time. It's about recognizing that inflation isn't just about gas prices or the cost of groceries. It's about your own expectations inflating beyond sustainable reality, pushing you into unnecessary risks. You need a bulwark, a fortress built on solid principles, not fleeting trends. So, if you strip away all the technical jargon, all the charts and graphs that make your eyes glaze over faster than tax forms, what's the single most powerful truth you wrestle from these pages? It's profoundly simple, almost shockingly so. To finish first, you must first finish. Period. This isn't a high-stakes sprint to dominate the market, to outperform every analyst on CNBC. It's a grueling marathon to survive it. Survival isn't a strategy you might consider. It's the only strategy that absolutely matters. Think winter of the market. It's coming, always, not if, but when. And when that economic blizzard hits with full force, when the headlines scream recession, when everyone else is panic selling their hyped-up growth stocks at rock-bottom prices, questioning every decision they ever made, that's when your personal ground rules, forged in moments of clarity, truly fortify you. They become your shelter. Warren Buffett didn't care if he looked stupid for 3 years or 5 or even 10, while others bought into the dot-com bubble or subprime mortgages or the latest tech craze promising instant riches. He didn't chase the trend. He didn't succumb to FOMO. He knew winter was coming. He understood the cyclical, inevitable nature of markets. He respected the long game. When it snows, and it will snow, only those with a warm house, those with solid, predefined rules, a clear, unwavering investment philosophy, they endure. They don't just survive the storm, they thrive on the other side, picking up the pieces others abandoned. This isn't about being the smartest person in the room, it's about being the most disciplined, about recognizing the pervasive noise for what it is, a distraction. The smart money isn't always the fastest money. Often, it's just the patient money. The money that stays put. The money that understands the power of compounding over decades, not days. If this hits home for you, if it resonates with that little voice in your head telling you to slow down, to think long-term, to cut through the BS, drop a like. It helps us amplify these crucial, often overlooked messages. Now, let's make this actionable, because thinking is great, but doing transforms your trajectory. I've linked a template for your own personal investment ground rules below. It's not complex. It's designed for clarity and commitment. Download it, customize it with your specific risk tolerance, your enough number, your non-negotiables. Then, seriously, sign it, put your name to it. And finally, frame it. Put it somewhere you see it daily, above your desk, on your fridge. It's not just a piece of paper. It's your constitution, your inviolable anchor against the relentless storm of market speculation, against the siren song of get-rich-quick schemes. It's your promise to yourself. The final wisdom: don't beat the market. You don't need to. Frankly, most people can't, not consistently. Just survive it long enough to let the math win. Consistency conquers chaos. Patience prevails. That's the real secret to financial freedom.